Alright, option spreads. Option spreads are such a big topic and could be the way that you start to succeed in trading. Since you understand the Greeks, implied volatility, and both the buyer and the seller sides of the options trades, now let's do multiple options contracts at the same time. These are called spreads. You do this to limit risk and be able to play in really any type of market. We'll go over the thought process of spreads in a volatile market, a non-volatile market, sideways price action, and directional price action. Yes, you can make good money if the stock does something or if it does nothing. The first question that needs to be asked is it a volatile market or not? If the stocks you are looking at has a high IV, you might want to be doing some credit spreads. So these are the spreads that you will be receiving the premium. You would want to do this when the premium is high, and you might be able to position yourself to collect all the premium from the buyer. If the IV is low, you might want to do a debit spread, meaning you're going to have to pay and risk what you pay, being on the buyer's side of the deal. Maybe you think the IV will increase. If you're looking at the IV rank, you may want it to be under 25 if you're buying the option contract, if you are doing a debit spread. And if it's above 25, then that makes it so you can get probably a decent premium. Although there are some stocks that always have high IV, even though the rank isn't that high. For example, Tesla. This usually has a pretty high IV. You also need to think, what do you want the stock to do? Or maybe, what do you want it not to do? If you think the stock is going higher and may hit the moon, you might not want to cap your max profit as much by doing a debit spread. A debit spread's purpose is to lower the time decay so that you have a little less risk, but can still get a great risk-reward ratio. On the other hand, if you think the stock shouldn't breach a certain level, you will probably want to be doing a credit spread, giving you limited upside and not as good of a risk-reward ratio, but does give you better chances of profit. Now, what if you think the stock is not going to go up or down? Well, there are spreads for that. On these types of spreads, you want the stock to stay within certain parameters of the spread. For example, if you think the stock should stay between 200 and 230, you can make a spread that makes it so that you will make money if the stock stays between 200 and 230 by expiration. Before I go over all these spread strategies, I want to mention that liquidity can be a problem for spreads, especially if you try to get out of the position before expiration. Options can have a wide bid and ask spread alone. When you do spreads, you are entering 2 or more options contracts at the same time. This can make the bid and ask spread even wider. You will see what I mean as we go through examples. I will be using Tastyworks to show you how each spread is set up. You can do this same thing on most brokers, but I think Tastyworks creates the clearest picture for beginners. So let's dive into some spreads and I'll see you in the next video.